market news now, the JSE was firmer while global stocks are mixed as investors digest attempts by Federal Reserve officials to rein in high expectations for interest rate cuts in 2024. Markets rallied across the board last week after the Fed signaled that inflation may have cooled enough for the central bank to shift to cutting interest rates in 2024. Meanwhile, investors will closely watch Friday's reading of the Personal Consumption and Expenditures Index. It's the Fed's preferred inflation measure. Meanwhile, oil steadied as investors consider the potential impact of the oil supply from attacks against ships in the Red Sea, which have disrupted maritime trade and forced companies to reroute vessels. To give us his perspective on the markets, we are joined by Han Tan, who is the Chief Market Analyst at Xfinity, joining us from Dubai. Han, thank you so much for your time. Your sense of market sentiment right now on the back of, coming out of the Fed, coming out of this, the Bank of, the European Bank releasing their interest rates, as well as the Bank of Japan this morning?
Yeah, so I think there was an initial FOMO that transpired right after the Fed meeting last week. But given how much stocks globally have really surged, I think it's only prudent that they are now taking pause to really assess whether they may have gone too far, too fast, right? So I think overall it is a healthy pause, but I think this is still a conducive environment for riskier assets, including stocks, given what the Fed has signaled to global markets just last week.
If you look at what the Fed signaled and the market reaction in the US, and then you look at what the ECB was saying versus the market reaction in Europe, how would you compare the two regions?
Yeah, so I think the Fed is leaning in to market expectations for those rate cuts. In fact, their own forecasts point to the same narrative. However, you've got the ECB and even the Bank of England as well, who are still trying to hold on to those hawkish signals, right? Or at least those intentions. So that's why you saw the euro and the pound both gaining against the US dollar, at least in the immediate sessions following those central bank meetings last week.
Let's talk oil prices. They seem to have steadied after climbing 2% on the back of those fears around, disruptions to trade near the Red Sea. To what extent is this could have on inflationary aspects going into 2024? How concerned are you about what's happening on that side?
Yeah, and that's a great point. You're right to point out that a resurgence in oil prices risks stoking inflationary impulses again, and that could upend some of the outlooks that we have for major central banks going into next year, right? I think having said that, I think the demand side fears, given the still continued slowdown in China and also the expected slowdown in the US economy, I think that places a cap, a limit on just how far higher oil prices can go. So while we could see more immediate or short-term volatility because of these geopolitical conflicts, I think overall from a supply-demand equation, I don't see much more upside for oil prices at this point in time.
Your thoughts on the Bank of Japan's move this morning? Obviously, not moving to loosen their ultra-loose monetary policy, but what would you say was the main communication challenge there for the governor?
Yeah, I think the main challenge in terms of communication will be to adhere to its message of patience, right? Clearly for yen bulls, those hoping the yen would go a lot higher, they were so sorely disappointed because they just can't wait for the Bank of Japan to finally ditch their negative interest rates regime, right? So you compare the market's impatient stance versus the Bank of Japan's message of patience, perhaps wanting to make sure that inflation truly will stick above that 2% target, for the years to come. They had missed the boat for decades now, since the 90s. So this is their one and only chance, so to speak. And with the Fed perhaps cutting interest rates, that window is tightening. So we'll see whether the Bank of Japan's patience actually will pay off this time around.
When you look at emerging market central banks, where do they fall when it comes to rate cuts and easing?
Yeah, you already have several EM central bankers cutting interest rates for months now. I'm looking at Latin America, I'm looking at Chile, even Hungary in Eastern Europe as well. So I think the broader macroeconomic condition with easing inflation, I think that has allowed them to perhaps normalize some of their interest rates, right? I mean, also keep in mind, emerging markets, especially in Latin America, they moved a lot faster, a lot sooner than some of their counterparts in the Western world. So that gives them some policy bandwidth to start cutting as well. But overall, I think emerging markets will be taking their clues from the Fed, and if the Fed can press ahead with those rate cuts, then it's bound for emerging market central bankers to follow suit as well.
It's kind of crystal ball season with a lot of analysts trying to look into 2024. What's your base case for the year, and what are you concerned about?
Yeah, base case is still for those Fed rate cuts. So again, that creates a supportive environment for stocks to go higher. And also keep in mind, it is a US presidential election year. So if you go back to 1980, pretty much every single presidential election year in the US has been a positive year for the likes of the S&P 500 and the Dow and the NASDAQ 100 as well. So, but beyond those macro factors, of course, we have to see if there are other geopolitical risks or even financial risks coming out of maybe the US or even the Japanese financial systems with these pivots. So I think another way of saying it is we'll see how well the global economy and financial systems can adjust to these policy changes by the Fed, the BOJ, and all these other major central banks.
Han, let's leave it there. Thank you so much for your time. That is Han Ten, who's the Chief Market Analyst at Xfinity, and looking at the Brent crude price trading at $77 a barrel. And we are watching events unfolding at the Red Sea. Of course, Goldman Sachs saying that right now the disruptions are unlikely to affect LNG and crude production, seeing that we already have these opportunities to reroute vessels rather. And other analysts also saying the same thing, but saying that it has increased the geopolitical risk premium, but we're keeping an eye on it. We're going to take a quick break. When we come back, we'll have more news for you, so stay tuned.